Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today I'm joined by Arden Jennings from Ausbil and Tobias Yao from Wilson Asset Management, and we're talking about stocks in stormy markets. Some people would say it's a cyclone. Let's start with you, Arden. Service stream, defensive, good announcements recently. Buy, hold or sell?
Yeah, it's a buy, Matthew. We really like the business. It's got management that are a safe pair of hands. There's net cash on the balance sheet. It's trading at a below market multiple, and we really think the market underestimates the transition from NBN activations to the maintenance revenue within the business. They've just made a really accretive acquisition into the utility space, which we think further diversifies the business. By all accounts, the business is tracking well, so we're expecting a good first half result. It's a buy.
Tobias, servicing the infrastructure world, telcos, water, energy, buy, hold or sell, service stream?
It's a buy for us as well. We really like the visibility of the business, sort of the future growth underpinned by NBN as well as the 5G rollout. They're definitely the best operators in the market, as evidenced by their industry-leading margins. 13 times PE is way too cheap. It's a buy.
Okay, nothing more resilient than drugs. Generics, Mayne Pharma, buy, hold or sell?
Mayne Pharma is a buy for us as well. The US generic price decline has stabilized, and we think they have a healthy pipeline of drugs to come on over the next couple of years. At the same time, we think they could potentially be a consolidator in the rapidly changing environment in the US. So they could pick up attractive assets and companies. So it's a buy for us as well.
Defensive industry, but the share price hasn't been too defensive, been off a fair bit. Buy, hold or sell?
Yeah, look, we think it's a buy as well. It is covered by our larger cap team, but yeah, like Tobias said, there is evidence of stabilisation in the generic drugs market over in the US. They're a top 25 provider over there now. So we do expect that gross margins can expand and they'll beat on the top line, which could, should lead to positive earnings revisions. It's a buy.
Okay, nothing could be more defensive than childcare. So we thought. It's been a pretty hard period over the last 12 months or so, oversupplied. G8, buy, hold or sell?
Yeah, it's a hold for us. Look, it was great buying at $2. There's no doubt about it, but at the current levels, it's up 50%. So it's a hold.
Could be great selling at $3.
It's a hold currently. Look, management have done a good job, implementing some new operational efficiencies within the business. New childcare subsidy changes coming in have had, it seems to be a positive impact on occupancy, which is obviously the lead factor for the business and the driver of earnings. But until we see that stabilisation continue, we'll stick on the sidelines for now. It's a hold.
Bounced like a moonball, G8 recently. Buy, hold or sell, Tobias?
It's a hold for us as well. They've had a great investor day. Stock price has rallied, but we're still worried about the competitive environment and the impact on occupancy rates. So it's a hold for us. We're going to take a wait and see approach as well.
Okay, here's your chance. Where's something that's going to perform in stormy markets? Which stock?
So for us, it's Austal Ships. So Austal, they build Navy and support vessels for the US government, and they also have a growing ferry business, as evidenced by some of the contracts they've won. We think the market underestimates the margin uplift in the order book, as well as the potential to grow the ferry side of the business very strongly due to the replacement cycle picking up. Stocks on 15 times PE growing at 15%. We think that's very compelling.
And it's going to be hard to beat a shipbuilding business in stormy waters. Have you got one for us?
Yeah, look, one that we like is Arena REIT. That's a recent addition to the portfolio. So this is a property owner of roughly 167 properties, 85% in childcare, 15% in healthcare. What we really like about the business is that it's got a long WALE, so weighted average lease expiry of around 14 years. It's got low gearing, around 24%, but they've got annual rent reviews, and we've seen what's happened with G8 and the investor day. Occupancy seems to have stabilised, and feedback is that conditions are improving in that sector. They've got annual rent reviews also, as well as 5-year market rent reviews, and they're achieving 5% uplift in rents. So we like the earnings outlook for it. Interestingly though, as sort of a bonus optionality for us is that Folkestone, which has been taken over by Charter Hall Education REIT, actually owns 4%. And we think this could be a prime candidate for M&A.
Well, they've put the mouth guards on and the shoulder pads, and they're ready for some defensive work in very tough times.